one thing that I think everybody should be aware of is, I think, especially subcontracting, revenue mix and the underlying mix of customer base is probably more important than size, from a multiple perspective.
So I was going to ask you that.
Yeah.
So talk a little bit about customer concentration and the types of GCs that these subs are working with and the importance of that in the underlying value of the company.
Yes. So a couple things. I mean, number one, customer concentration is probably the single largest driver of a multiple in this space, right?
Really? Okay.
I mean, you come across a company doing 10 million of EBITDA, it sounds great, and you find out that 90% of the revenue comes from one single customer or one GC. That's really hard to mitigate.
Hey folks, another episode of Mobilization Mindset here. My name is Drew Aldridge, President of Mobilization Funding, and I'm excited about our episode today. We've got Graham Woodard from 367 Advisors, an investment bank here based in Tampa, Florida, but they work all across the country, and they focus on specialty trade companies. They focus on commercial subcontractors. We're going to talk about a lot today. Graham, welcome.
Hey, buddy. How are you?
Yeah, I want to just full transparency. Graham and I have been friends for a really, really long time. My wife and I moved here to Tampa, like 5 years ago?
Yeah, I think that's right.
And you've been a friend ever since.
Yeah.
So
I'd like to take credit on behalf of everyone in the city of Tampa. I think I was one of the first people Drew met, and I'm going to guess that it was a big reason he came down to Tampa.
Yeah, huge reason why we came down to Tampa, and actually ended up moving into a house about 4 doors down from you.
Yeah, that's right. Yeah, we were in the same neighborhood for a little bit. And great friends. So thanks for having me.
Awesome. Well, the first question I got for you, we're going to start off like really simple.
Sure.
And then kind of get a little bit more granular. And then obviously you can pitch in with any questions that you might have. But what is an investment bank?
Yeah, it's a great question. And I think a lot of companies out there don't know the answer to that question. And there's different levels to it in the market. What's an investment bank? When people hear it, I think a lot of people think of somebody investing capital. They think of private equity really is what they're talking about. An investment bank is truly an advisor to companies that are looking to go through a transaction. Now that could be growth equity, it could be a capital raise, it could be an M&A event, it could be a full sale. There's a lot of different things that could take place with that. And then there's different levels in the market. As we go super upstream, an investment bank might go out and offer bonds, for publicly trading companies. What we're talking about in the lower to mid-market space, primarily it means a advisor that's helping you take your company to market and go through a transaction. The term business broker gets used a lot. The term M&A advisor gets used a lot. So I try not to worry about too much about the terminology and more about what is that service provider doing for the companies out there that we're trying to represent.
All right, I want to define some terms because you use a lot of terms there. So like when you say growth equity, what do you mean by that?
Yeah, so I mean different sectors of the market provide or maybe need different things, right? Like a specialty service contractor is probably not as large of a candidate for growth equity. To answer your question, growth equity, it typically comes in non-control investment into a company, right? So there
less
might
than
be
50%
less
usually.
than 50%, right? There's a VC, a venture capitalist might be a good example of this. Hey, we're going to invest 15% into a company that's really high growth, like Uber, and we're going to give them X amount of money for that, right?
Yeah.
That's a part of what the ecosystem does. I think for this conversation and for the specialty trade contractor space, the M&A side, the control transactions are really a lot more prevalent.
Yeah. And even on the growth equity side, like in the specialty contracting space, I kind of see more sort of independent sponsors going out there and said, hey, let me help you operate the company. Here's here's X amount of dollars for 40% of your business, and you can take some chips off the table.
I think that's right.
Yeah,
it's a transaction out there. I think it's probably the lowest of volume.
Yeah.
Right. If we were to talk about the highest volume transaction that occurs in the market, it's going to be a full sale.
Yeah, full sale.
It's going to be a control, sale event.
Yeah. And define lower middle market. What do you mean by that?
A lot of people probably have different opinions of what they mean around that. For me, that means companies doing probably between 5 and 50, maybe up to 100 million of revenue, and earnings or profit or net income or EBITDA somewhere between 1 and 10 million or so. I think some might argue that it's slightly higher than that. I think the mid-market space, so there's lower middle market, then there's mid-market, right? Maybe mid-market starts at 100 million of revenue or somewhere in there. It's within that range.
Yeah, Bank of America is going to have a different definition of mid-market than a local community
When
bank.
I think about the market that we serve, we're mostly working with companies doing between 10 and 150 million of revenue.
Yeah, makes total sense.
That is really our target market. I think there's plenty of businesses out there that fit that mold and that criteria. But revenue is not always the most important part, as you and I know.
Yeah.
I mean, we want to make sure we see profitability. We want to see strong margins. I'd rather work with a company doing $50 million in revenue with 20% EBITDA than $150 million in revenue with 5% EBITDA.
Yeah,
right?
and I just want to make something clear for everybody. When we're talking about EBITDA, you think about your net income, which is your bottom line, and then you add back your interest, amortization, depreciation, all these financing relating costs, plus non-cash related expenses.
Correct.
Add back that to your net income, and that's kind of what your true cash flow is, and that's what a lot of companies kind of base their underlying valuation on.
Yeah, that's exactly right. And what we're trying to do when you get to EBITDA and an adjusted EBITDA is make the capital structure neutral.
Neutral.
Right?
Yep.
The fact that you have debt on your business does not mean that that next buyer will. So we need to add back that interest, right? So we are trying to use EBITDA as a proxy for cash flow. And then certainly there's adjustments from that too. One-time events, a settlement, something that only happens once in a while in the business. We
Not in the normal course of business.
Not in the normal operating, course of business. Yeah, we look for those anomalies and try to, obviously make that adjusted EBITDA as realistic as possible.
Yeah. And then there's all kinds of ratios that you can get into when you're talking about EBITDA, and it really is comparing apples to apples, because one of the valuation methods that Graham and his team use and other investment banks use is that comparables, right?
Right.
And you want to neutralize that capital structure to be able to compare apples to apples. And now a lot of other financial CPAs or experts might argue you on the nuances of that, but we're keeping it broad. So we can get into the details here in a little bit. Okay, so I'm a $25 million concrete specialty subcontractor. I've owned my company for 10 years. I'm thinking about a succession plan. I don't have any kids that want to take over my company, so I'm looking at selling my company, right? What's the first step I take?
That's a great question. I mean, I think one of the single most important, things that a business owner can do is understand the value of their company.
Yeah.
And I think you might agree with me on this. A lot of business owners are not taking that step. No. They're not having that conversation. They have a number in their mind that might not be rooted in fact. So what I would tell you is
it's rooted in bias.
It's rooted in bias, and we're all biased, right? I mean, I think my house is worth more than the market probably thinks it's worth. I really like it.
I think your house is worth more than the market probably.
Right. I think that's probably true. So I mean, you gave me an example of someone who's ready actively to sell. Let me take a step back from there. Even if you're not ready to be active to sell, these are the conversations you should be having as a business owner, because it can change quickly, right? And you don't want to be in a position where you're undereducated and then overwhelmed at the same time, right? Because if there's ever a situation where you feel like suddenly you need to sell, change of health, change of motivation, burnt out from the business, whatever it is, other than just your normal kind of aging and retirement factors, you don't want to be feeling distressed at that point in time. So I really encourage people, and a lot of the prospective clients we talk to them for years ahead of a transaction.
Yeah, you do.
Because you need to have that, intimacy and knowledge of the business and have really realistic conversations. So to answer your question, if you're ready to sell, you need to talk to an M&A advisor.
Yeah.
Okay. Depending on size, maybe it's more appropriate for a business broker. Maybe it's a boutique size M&A advisor. Maybe it's a really large investment banking firm. Depends on size, right? But you should be having those conversations. You should probably have multiple, right? I mean, I love for our prospective clients to talk to us, but I oftentimes do encourage them to talk to some others too.
And I've referred you some business in the past, and I always tell you up front, I refer folks to 2 or 3 people so that they can make the choice.
100%.
That they can make the.
And
I'll
with
give
any
you
service provider, right? Any service provider, attorneys or accountants, they should make sure that they're really comfortable and that the group that they may be hiring understands their business, understands their space, knows the multiples that are taking place. So going back to your original question, you need to talk to an M&A advisor, get an NDA in place with them, a non-disclosure agreement, so that they can get some information about your business, and make sure that you're speaking to someone that understands your market, can analyze your business for you, right? Can look at your P&L and your balance sheet and come back to you and say, look, here's the valuation range that I think you're going to be within. Okay, I think you're going to be between X and Y multiple. We think your EBITDA is $2 million. Here's the sale price. Here's the likely structure that you're going to receive. Here's the likely terms and conditions. And make sure that they're walking you through their entire process. How long is it going to take? What steps are there? How much time is commitment will it be for me? What risks, are there out there? What can I mitigate now so that we have a cleaner transaction process? So those conversations are best, had a couple years before a full process, just so you're ready and you're educated. Because one point that I don't think business owners think about a lot is it takes time.
Yeah.
and they're already running their companies. And so one thing we strive to do is make sure that when they do sign up with us, that they're ready for it.
Yeah.
And that they can keep their eye on the ball of the company day to day, and that we can go do the work for them.
Yeah,
And that's really key.
And that's not really in their core scope of what they do every day.
Not at all.
Like they're getting a company ready and the financials and all of the due diligence material. Due diligence material, just to be clear, when you go to market, you have companies or private equity firms that want to potentially buy you. They go through a due diligence period. So I'm going to get you to talk about the process a little bit, but that is not your core business. Just like I said in one of the videos, in one of the past videos, the payment terms in the subcontracting space, in the construction industry generally, makes the subcontractor the bank, right? You didn't sign up to be the bank.
Right.
Just as you didn't sign up to be an M&A advisor. So if you're looking to sell your company, absolutely loop in someone like Graham. So my question to that is, when a company decides to work with you, what does that process look like, and what kind of things are you doing to get them ready? Not to engage this buyer, but to get them ready for that, okay, we're about to go to market. What does that process look like?
Yeah, it's a great question. And look, there are other advisors out there that work with companies to become exit ready. And there's a lot of great referral sources that we bring in, a couple years beforehand that are going to kind of be more operational with the company day to day. We're not there to be operational. We just want to make sure that it's transaction ready to get to market.
So are those like outsourced CFO firms?
Outsourced CFOs is a great version of that. There's some outsourced strategic consultants that come in and can kind of almost act like an in-house corporate development professional and get the company ready to go through a transaction.
Okay.
But for us, our clients come in all different shapes and sizes from a readiness perspective. Sometimes we get a phone call from a trusted source like you, and this individual or this company is ready to move forward immediately, and we just have to go, right? And so we might not get all the items that we wanted on the menu, and that's okay. We have to be prepared for that. Sometimes we have a client that we've been courting for 4 years, and so we've already done all the steps. We're already ready. We have the data room set up. We've done the
what's the data room?
Great question. So you talked about the due diligence process, right? So most times either an advisor or a buyer ultimately is going to send you a due diligence request list, which is, think of a checklist with 150 items of it. All your, financial information down to your trial balance and general ledger, all your corporate documentation, bylaws and, how you're structured, everything you can imagine about the business, right? And then questions on top of that. So for safety purposes and compliance reasons, a lot of people use a data room, a virtual data room. Think of Dropbox or Box.com or some of those other providers. They use that as a source of information collection.
Okay.
So it's not just happening over email. And I would encourage that, right? I mean, that let's make sure it's all in a safe place where you can find it, you can archive it, you can access it later. To the extent that you're talking to more than one buyer, it's all right there, so you don't have to worry about what you emailed to who, different versions. There's a lot of good reasons for that, right? But going back to the process question, we want to make sure that we're going to set up a data room, we're going to collect the information, and then our process can be different for every company, but generally speaking, we lay it out with our client. We're going to write a SIM, which stands for Confidential Information Memorandum, so think of a 25-page document on the business. We're going to put together a buyer list so that, if we're working with a concrete company, like you said, we're going to find the buyers in the concrete space. And then we're going to market to them and run a bid process so that all the offers come in around the same time.
Yeah, and I just want to make something clear. Graham touched on something very important here. When you work with someone like Graham, they're not just taking all this due diligence material, creating a SIM, which is essentially the marketing package for your company that has all of your company's information, the investment rationale, the growth opportunities. But they are not just sending that out to a bunch of random buyers. I mean, they are sending it out to buyers that have a history of buying companies just like yours, right? So these are very targeted companies. And the firms like Graham's have relationships with these buyers because they probably sold companies to these buyers in the past. Okay, so I have a question on the buyer, right? There are sponsor buyers, like private equity buyers. There are strategic buyers. There are family office buyers. There are a variety of different types of buyers. Can you walk through the 2 or 3 or 4 sort of buyers that you see most in the specialty, space?
Yeah, absolutely. So the buyer universe, as I refer to, is more diverse now than it's ever been before, right? I mean, it used to be a lot more simple, right? When you were going to market. Now, as you talk about the evolution of family offices that are doing direct investing, independent sponsors, search funds, right? I mean, there's this really evolution of really entrepreneurial, activity within the M&A space. So who do we mostly sell companies to? Well, we mostly sell our clients to, I'll call them strategic buyers backed by private equity, right? That's a popular, common refrain in our industry is, let's just use an example of a commercial HVAC business.
Yeah.
Okay.
Which is like hot for the past 5 years.
It's been very, very hot. It's been very popular.
No pun intended.
Yeah, there you go. Hopefully it's not too hot in the world.
Yeah.
So we do a lot of work with mechanical services contractors, commercial HVAC contractors. We do it on residential and commercial, but for purposes of this conversation, commercial, right?
Yeah.
So for us, we track maybe 80 private equity firms in the country that have a holding in that space. And what's their goal? Well, their goal is to make a lot of acquisitions under their portfolio company to diversify revenue, to diversify their customer base, diversify their geographies that they serve, bring in more leadership, integrate these businesses, right? So if I'm working with a Florida-based commercial or mechanical services contractor doing 20 million of revenue, I'm going to go and, like the likely outcome there is it's going to be a strategic buyer backed by a private equity. And why do I like that? Well, I love the strategic aspect because they are intentionally in the business. They're going to likely get along with our client pretty well.
Yeah, they understand the business.
They're
The
both
learning
operators.
curve's flat.
100%.
Yeah.
100%. We don't want to sell a company to somebody that doesn't understand their business.
Yeah.
That cannot work out so well. And I like the private equity aspect because they're backed by capital. We don't have to worry about the lack of financing that may be available. So that's sort of the gold standard in my mind. If it's a large enough company, they could go to a private equity firm directly, right? If there's a leader in place that wants to potentially roll some equity, take a second bite of the apple, be part of that themselves, you have to be larger to qualify for that, but that's a circumstance. And then something I think that you would find that you see very often is the independent sponsors and search funds.
Yeah.
So for the benefit of the audience, what does that mean? Well, this is sort of an idea born out of a couple universities in the country that said, hey, what if we taught our MBA graduates to go run a business themselves?
Yeah.
Find a business, finance a business, and run a business.
Yeah.
Okay?
I mean, there's there's kind of, this is really recent, the past 10 years.
Past 10 years.
Like you have all these people who go get their MBA or go to business school.
Right.
They're like, hey, you don't have to go work at Apple. You don't have to go work at McKinsey or BCG.
Right.
Go find and I've said this before, the more boring your business is, the better, especially in subcontracting.
Yep.
They're like, go buy a boring business, a business that does work that will never go away,
Right.
and has good fundamentals. Go run that and grow that.
That's exactly right.
Yeah.
So we don't do a ton of work in that space. I think mostly from a size perspective, right?
And they're not the buyers are not necessarily capitalized.
You just have to watch out.
Yeah.
Right. I mean, and this is something I would caution people. There's a lot of direct outreach to business owners nowadays.
Yeah.
Any business owner listening to this right now is going to relate to the fact that they probably get 10 to 30 emails a week that they delete from either folks like us or from buyers directly.
Yes,
right?
exactly.
So we're all in the same boat together. It's very hard to sift through.
Yeah.
Right. If I wasn't in the M&A profession and I got that many emails a day, I wouldn't know which ones are good or bad.
Yeah, but if you had an M&A advisor.
But if you have an M&A advisor, whenever we sign up a client, I say, just go ahead and send me any of the emails from anyone who's ever reached out to you. Forward them to you, and I'll vet them ourselves. What do we end up getting? Well, I get like 120 emails, right? And going back to the original point, you just want to make sure that you don't go too far down the road with a potential buyer who doesn't have the financing lined up to actually complete the acquisition.
Yeah, because you get to the finish line, right? You spend all this money on due diligence, or they're spending the money on due diligence, but you're spending money on getting ready for due diligence.
You're spending money. Your attorney's probably looking at the letter of intent.
Charging you by the hour.
Yeah, your attorney might be looking at some of the structural items. I mean, you're going to spend money and you're going to spend time, which is even more important.
And a lot of these independent sponsors will come to you and say, well, you won't get the liquidity right now. Can you give me a seller note of some sort?
Yeah, there's definitely groups out there, and I don't want to be too derogatory towards that community because there's a lot of great ones. There's some incredible success stories out there. You just in working with someone like us will help you understand which ones are the good ones to go to,
and not real.
And it's just a simple conversation to vet and just make sure that they're lined up and they're being thoughtful about it. And even beyond the financing capability, I think it's really important to find a partner that makes sense for the business. Right? I mean, something I really challenge our clients to think through is, what does good look like to you from a new owner perspective?
I love that question.
Are they gonna treat your employees well?
Yeah.
Are they gonna be able to fill your seat necessarily? Do they want you to stay around? If so, for how long? If you're not there, what happens? Do you have a GM that's ready to be elevated? Do you have another leader in the company? When I say people, has this other firm, has this buyer have they owned other similar companies? Can we talk to one of their past CEOs to see how they acted?
Yeah.
What their bedside manner was?
Especially if they want to keep the CEO on board and he gets a second bite of the apple on a second sale. He
100%.
wants to know that these guys have done this before.
He wants to
What's
know
the
that
track record?
Yeah, the Midas touch, right? I mean, is it going to turn to gold if you touch it or not?
Yeah.
And oftentimes, I normally ask for around 3 CEO references from a lot of the buyers that we end up talking to, and I think it's really, really important. I don't need to be on those calls. I just want our client to talk to somebody else and just ask unbiased questions.
And that's another piece of valuable service that someone like Graham's firm can do. I mean, they're interviewing you, the buyer's interviewing you, but you are also interviewing them.
That's 100% right.
But especially if they look at you and say, hey, this is a dime in the rough, we really want this deal.
Yep.
That's when you have more and more leverage.
Absolutely. And there's different, right now we're working on a couple of transactions that I think are really relevant to it. But, one of them is Florida-based, and, our client's really interested in being the platform in the state of Florida. So we talked about the platform versus the add-on earlier.
Yeah. Can you explain a little bit? Because just to make things clear, we're talking about private equity firms who have a portfolio of separate companies, right? And then oftentimes what Graham's talking about is one of the companies within the private equity portfolio will go buy a company and just roll them into that singular company within the private equity firm. Right. Or they'll just buy the company outright and it's a separate entity within the portfolio. Is that right?
Yes. Generally right. So, when you're a private equity firm, we talked about the commercial HVAC. Let's stay on that example, right? So if I'm XYZ private equity firm, I own ABC Contractors, which is a Kansas-based, commercial, commercial HVAC business, and I've acquired 4 other businesses: one in Georgia, one in Kentucky, and one in New York. Okay, and so I have a client in Florida, and what's important to him is maybe his business is 20 million in revenue. Maybe he's not large enough to be a new platform for a private equity firm, or maybe he doesn't want to, right? Because it requires a 5-year hold period and a lot of a lot of work and maybe some travel and some things that person may or may not want to do. But what they could want to do is say, we want to be the first acquisition in our state, and we want to be responsible for building out that territory for you. Okay, so that can be kind of an interesting hybrid approach, and one of our clients is going through that right now. So
interesting.
What would be the reason why somebody would want to do that? Well, one, they might find it really fun from a leadership perspective. A lot of our clients, as they get later in their career, they've been doing it for 30 years. It's not about money for them as the only reason anymore. They want to kind of keep the brain active. They want a new challenge, right? So
it's almost like they want someone else running the day-to-day, and they want to be the strategic.
They love going strategic, right? They don't want to deal with payroll anymore. They want to kind of sit on top of the business for a moment and say, what could I do to grow this? How could I go from 20 to 100 million within my geography?
Exactly.
Because I'm not going to go up to Kentucky and start providing services. But you know what? I'm not in Naples, and I'm not in Miami, and I'm not in Jacksonville, and right now I'm only in Central West Florida. So I think that's a really interesting avenue as well. So one, that might just be fun for them. Two, they might end up getting more value for the business by being able to do that too. So I mean, that's important, right? Is if we're going to try to find value drivers, there's a lot that we can talk about there. But one of those is, do you have the scarcity value where the buyer wants an asset in Florida, as an example, to use this continuous example? They know that their overall company is going to be a lot more valuable if they're able to kind of crack the nut in that particular market, and you are there to answer that question for them. Well, that's going to drive up the multiple.
On that kind of example, we're HVAC company in Florida, right? And kind of being the harbinger for a more expanded company within Florida, right? Can you talk a little bit about, given in the sort of comparables method of valuation, right, on with EBITDA being the underlying sort of KPI that you're solving to, can you talk a little bit about, as you grow in EBITDA, like you might be a $4 million EBITDA company and trade at 5.5 times,
right?
But once you become a 10, you're trading at 7. I don't know if those are the numbers, but can you talk about that arbitrage a little bit?
Yeah, so the idea within a private equity construct, many times, not all the times, but many times, is as we build scale, we are going to trade for a higher multiple than we would otherwise, right? So if I'm going back to the XYZ private equity firm doing the strategy within commercial HVAC, when I get to 20 million of EBITDA, I think I'm going to trade at 12 times, and I'm acquiring companies for 6 times, right, on average. So therefore, just from doing nothing but buying and scaling and integrating, I've immediately created 6 times of value. That's considered the arbitrage there, right? So every industry has a different, what I call breakpoints, which is, different levels in which the multiple pops up. If I were to be as general as I possibly could about it, from 0 to 2 million of EBITDA, probably kind of lives within one multiple range, right? It's hard to say. Let's just, if I'm going
It's
to
the law of small numbers.
Yeah, law of small numbers.
There's probably concentration. There's probably a lot, like not a lot of differentiation.
It's probably a little bit more mom and pop.
Yeah.
Maybe from 2 to 5 of EBITDA is another break point, right? And when I say break point, there's a range of multiples within there. If I'm in commercial HVAC and it's largely, service with a little bit of construction to it, a good revenue mix that buyers like to see. I mean, at 2 of EBITDA, maybe you're getting a 6 or 7, and at 5, maybe you're closer to an 8 or 9, right? I mean, like there's a space there, and in most industries, kind of break over a hump after you get into like the high single digits to 10 million of EBITDA. That's sort of considered a pretty scale asset within an industry, and you should trade at a higher multiple. But one thing that I think everybody should be aware of is, I think, especially in specialty subcontracting, revenue mix and the underlying mix of customer base is probably more important than size, from a multiple perspective.
So I was going to ask you that. Yeah. So talk a little bit about customer concentration and the types of GCs that these subs are working with, and the importance of that in the underlying value of the company.
Yes. So a couple things. I mean, number one, customer concentration is probably the single largest driver of a multiple in this space, right?
Really? Okay.
I mean, you come across a company doing 10 million of EBITDA, it sounds great, and you find out that 90% of the revenue comes from one single customer or one GC. That's really hard to mitigate.
Yeah,
right? I mean, that's going to be, can you sell that company? Yes. What's going to happen? It's going to be a structured transaction.
Yeah.
Right? It's not going to be all cash at closing.
And it's probably going to be a very different type of buyer than what you were kind of outlining generally.
Now, I mean, the good news there is that a larger buyer in the space might come in and say, hey, since you're so much smaller than us, under our ownership, that customer would only represent 10% of revenue. It's 90% for you, but it's 10% for us, so we're less concerned. However, we're still going to structure your deal to make sure that that customer stays and continues on.
And we've been trying to get in with this GC for a long time because it's a large GC. None of our other companies really work with this GC. It'd be a great opportunity.
Yeah, that can definitely be true too. So what I hear a lot in this space is that a lot of business owners, they pick and choose the GCs that they work with, right? They want there to be trust, and they want to make sure that they're paying on time and that they're doing all the things that are important, and that's a really good thing. And they should be doing that, right? I mean, they shouldn't. Most of the time, those GCs probably have a better understanding on the pricing and the profit margins that both are expecting. And so you're not just out to bid. You're not just a piece of meat. You're not the lowest common denominator wins the deal, right? That's not where you want to live in most businesses. So I think that's a really healthy habit to have. The only caution I would have there is don't do that to the point where you don't have a diversification of revenue. If you're so picky about the GCs that you work with, and you're only willing to work with 3 of them, that means you're only going to ever have 3, customers, right? And it makes your business tougher to sell if that's your goal.
And there's also an incredible amount of risk there too.
Incredible amount of risk.
Especially if you've built like a back office and overhead to support X amount of revenue, then you lose one client.
To lose one.
Then all of a sudden you're running out of loss probably.
Right. And I mean, I don't know if this is as relevant, but if you can get some direct to owner work as well, that's super helpful. I mean, not all things have to go through GCs in the subcontracting space, right? I mean, you can still go out there as a commercial HVAC group and say, hey, we have a division that works through GCs, and we have a division that goes direct to owner, and we signed a master contract with XYZ retail store, and we handle their 20 locations in our area. I mean, that's really valuable revenue.
Yeah, especially in the HVAC space. We've seen developers who have a property management arm, and then the HVAC company just literally works direct with them. There's no GC involved. It's just like, hey, we need to do new freezer. We need a new cooling system. They just go straight.
Well, and also sometimes the relationship starts through the GC, right? Maybe it's a new construction building, and they're coming in and they're putting the boiler in, and then they come and say, who's going to service it?
Yeah.
And the answer is we can do it. And can we get a contract directly with the end user now? I don't think the GC would have any issue with that in most circumstances. So that's a great way to build some recurring revenue, some service work. In most industries that we serve, in especially subcontracting space, service revenue is greater than construction.
Really?
Yes, like that is what you are going to strive for.
Interesting.
Again, I'm only talking from a perspective of, do you want to sell your company?
Yes.
So if you don't want to sell and you're just thinking about cash flow, do whatever makes the most sense for you as a business owner.
What about those subs out there that don't have that service? I mean, HVAC, that makes total sense, right? But you have
roofing doesn't have a lot of
concrete. I mean, all these things that are kind of on a project by project basis.
Right.
Talk to me a little bit about that.
Yeah, I mean, I would say all that's going to happen there is it makes the buyer universe a little bit smaller, right? And it makes the multiple go down. Doesn't make it any harder to sell necessarily outside those two factors, right? So if you gave me two companies that were of equal size, so both of them are 20 million of revenue, 4 million of EBITDA. I'm going to stick to commercial HVAC because we're on topic. One is 80% new construction with 20% replacement. Okay, that's going to trade at 1 multiple. I'm going to say 4 times for this conversation. Okay, the other one is doing 80% service and 20% construction. Oh, by the way, of the construction they're doing, they're only doing it for their service customers. Okay, that might trade at 8, 9 times.
Okay,
there's a big difference.
There's
there.
a huge accretive value to that recurring revenue.
Now let's go to your other question. Who am I talking? If I'm talking to someone who doesn't have service offering, roofing as an example.
Okay.
I mean, there's some roofing service, but no roofing contractor has like a huge amount of roofing. There's definitely no monthly agreements in roofing.
Yeah.
Right. I mean, it's hey, a few shingles fell off because of a hailstorm, come replace it.
Yep.
It's not super attractive work from a margin perspective, but it does kind of help you own that property, right? But what can we do there? Well, in those industries, buyers care more about replacement work than they do new construction.
Okay.
So you can still be doing construction type projects, but if you focus more on retrofits and on replacement work, that's going to be more valuable revenue than
because
than new
it's not completely. It's actually you think about the cyclicality of the new build, right? You're not completely reliant on new builds, new construction. You have the opportunity to work on so many different customers that have existing assets out in the universe.
Right. It takes some volatility in the market out of the equation.
Yeah.
A lot of buyers still remember 2008.
Yeah.
Right. So we're not so far away from that where it's not in our memory. A lot of owners still remember 2008. So when the new construction market slows down, it can be pretty harmful. And what I find with a lot of contractors is that the ones that do that type of service work, the one that do that retrofit and that replacement work, they're known for it in their area. So it's already part of their DNA. They just need that extra push maybe from an advisor or from, a resource for them to say, hey, you're doing so good with that.
Yeah.
Keep expanding that offering because that's really valuable. Because the groups that are known for new construction, they're known for new construction.
Yeah, and that brings me to a point. We did a Business Foundations podcast a couple days ago that we released last week, and I was talking about focus, right? A lot of our specialty subcontractors that we talk to try to take as much work as they possibly can. Like regardless of the GC, regardless of the project size, regardless of the project scope. And one thing I was talking about is you can grow by narrowing your focus and being really darn good at what you do.
Yep.
How does that play into some of this selling?
Well, whether you're GC or not, whether mobilization funding, 367 advisors, we should all have our own ideal customer profile.
Exactly.
I'm a big believer in that because if you know what you're looking for, your ability to find it is much easier. Number one, and if you tell people what you are looking for, your ability to be known for it really gets enhanced, right? So. And
operationally, it reduces the friction internally. I mean, we've been here at Mobilization Funding before and said, "Hey, we can help this person, this person, this person, this person," without really a definition of our ideal customer profile, and it created a ton of friction internally.
Absolutely.
Because there are certain types of companies we're just not suited to finance.
Right.
But we know we're really good at construction.
Right.
So we said, okay, we're going to focus on construction.
Right. And then from that becomes better service.
Better service.
Your customers are happier.
Employees are happier.
GCs are happier, right? Your team's happier. I mean, if I put myself in the field for a specialty subcontractor, and I'm really good at new construction, let's just say, right? I'm a field employee, or I'm a superintendent. I'm like the best at new construction. But then you send me on 2 weeks of service calls. I have no idea. I'm not a diagnostics guy. Right, yeah. I'm a lay the brick guy.
And your brand and reputation are so incredibly important. And if you fall, you're so good at one thing, and then you fall short at another thing, you're only as good as sort of your least efficient offering.
Yeah,
right?
I think that's probably true. I mean, people are only going to remember you on that one job site. And what's really frustrating about that is you might already have the talent, you're just not allocating it appropriately. Right. Yeah. So I'm a big believer of specialization in the work that you do. I'm a big believer of really sitting down. I mean, if I'm talking to a C-suite right now, sit down with your key people and say, who is our ideal customer profile? Whiteboard it. Right? I mean, figure it out and why. I mean, challenge yourself. If we're only going to work with GCs, well, do we want to work with the largest? Are we working with the mid-size? Do we like the regional players? If we're working direct, what I find with a lot of our clients is that they have a nice specialization in industries too. Like we did a deal last year that was a 75-year-old commercial HVAC business in Central Florida, and they were really well known for education. So any of the schools that popped up, around the 5 or 7 surrounding counties, they were the group that won those deals, right? So I mean, they were really trusting that space. I'm working on one right now up in the up in the north, and they're really well known for industrial buildings and manufacturing, right? So you can't be good at everything. You're not going to do great at retail and at healthcare, and it's unlikely.
I'm not talking just about scope.
Right.
I mean, you might think, okay, a job at a school is the same functionally as far as scope goes as a job at an industrial facility.
Right.
But you have a different pair, you have different payment terms, potentially different geography.
Right.
Potentially the scope is not as similar as you think it is.
Right.
Different requirements. So those differences and that lack of focus can be hidden, right? And you only find out when you actually do it.
Right. I mean, I it's almost like if I get sent like an oil and gas deal out of Houston, it's like I don't know the inside joke of why everyone else has passed on this. We're not oil and gas. I don't know anything about it, right? So it's
you don't want to be the sucker.
Yeah, you don't want to be the sucker. It's like, hey, why did all the groups in education pass on this one? It's coming to me. It's like, well, maybe that building wasn't really ready, or whatever it is. So I think you need to be focused. I think you need to be smart about it, but also while staying diverse, right? You don't want to limit yourself so much to a point where, hey, we only do really good at retail. And all of a sudden now we have a customer concentration with a large pharmacy chain, and that large pharmacy chain goes into bankruptcy. Now we're in big trouble. Now we're in big trouble. So let's be smart about it. Let's think about it from a service offering and from an end market perspective, and from a labor perspective. I think is also a useful way to consider that as well.
Yeah, we're almost out of time here, so I just wanted to ask two more questions.
Sure.
One is, okay, I've got all my due diligence together. I've hired you. We've done our whole process, SIM. We've attracted some buyers. They're interested. Talk to me about the process from sort of that point where you get interested buyers to actually selling your business.
Yeah, so most groups like us are going to run a competitive bid process so that all the offers come in a time frame that's consistent with one another.
And there's like a date that
we normally do a bid date, and maybe there's a little bit of flexibility around that, but overall, over the course of a week, all the offers for the deal should come in, right?
Yeah.
And that's really important because that's where you're going to build competitive tension. One. Two, it's also the point in time where you can lay it out for your client and create that optionality, right? I tell people, really, for service, we sell options and we sell education. And then what we're trying to do is just give our client that optionality and parallel that with the education that we're giving them so that they can make a good decision that helps them sleep well at night for the rest of their life.
Yeah.
Because most business owners only get to do this once. So it's incredibly important that they're happy with the decision that they make.
Yeah.
So what happens from there? We'll pick an offer with our client to kind of move forward with in a negotiation, make sure that we're getting all the terms that we care about in there. You have to think about a lot of structures.
Well,
right?
Let me just ask you real quick. So you get those 5 interested buyers.
Sure.
What do they submit? A letter of interest?
They would submit a letter of intent at that stage, right? Something that we can truly negotiate. Call it a 4-page document. Price, structure. What are we doing with key employees?
And typically, guys, if you're doing this alone without someone like Graham, the risk of signing a letter of intent that is not working in your favor, you always want someone like Graham to review that letter of intent to make sure it's market.
Yeah, I probably reviewed 1,000 letter of intents in my career, so I'm pretty good at them. And we bring in the other resources too. We want to bring in your attorney. We want to bring in your CPA, look at the tax consequences of a deal, stock versus asset deal. Are we selling a C Corp or an S Corp? How's that going to work out?
A wealth manager maybe?
A wealth manager to make sure that the net number is going to be sufficient for the client to live on, for the rest of their career life. The attorney, because there are going to be binding provisions within, even though the LOI is not really considered a contract, it's more of an understanding to enter into for the due diligence period. There are binding provisions in there, so we need to make sure the attorney is taking a look at that and that's satisfactory there. So it's really a team effort with a lot of people that need to be on your side, but we're going to help lead that. We're going to work with you to negotiate the terms that you care the most about and your other advisors. And what I like to tell people is during that bid process, that's when you have the most leverage as a seller. And as soon as you sign an LOI, the leverage kind of shifts over to the buyer a little bit more. So that's a really important moment in time where you get what you need to get in the offer. Don't be scared to ask that extra question. What's my salary going to be moving forward? Hey, I see in here that you want me to stick around for 3 years. Well, what's my salary going to be? What's my benefit package going to be? What are my fringe benefits
Do I have to roll over equity?
Am I going to be rolling? Exactly. How does that work? Are we going to be, how long is your hold period if I'm rolling over equity? Is that going to be on a tax deferred basis or I'm going to pay tax up front? There's a lot to think about there. So you need a really solid M&A advisor by your side that entire time.
Yeah. Awesome.
I got a couple questions for you.
Okay, here we go.
So, Drew's big into leadership, as the audience probably knows by now. One of the questions I have is what would you say the most underrated business quality and leadership is in today's day and age? Not the obvious ones, not the show up and shake hands and work hard. What's underrated that not enough people are thinking about?
Yeah, from a leadership standpoint, I think one of the most underrated and basic things is being seen and heard as a leader. I've worked in my career for 15 years, and I've worked for people who kind of told you what to do, but never taught you how to do it, never showed you. And when the going got tough, they were nowhere to be found. I kind of equate it to like that field commander in the military versus also being on the hill and being able to see the forest through the trees.
Right.
I think being able to do both, being seen and heard from a leadership standpoint in the trenches with your guys and gals, and also being able to see the forest through the trees, I think that is extremely, extremely important. Nobody who's going to be working really, really hard for you, in my opinion, respects the leader who's never seen and heard. They're only seen during the good times.
Yep.
During the bad times, I don't know where they're at.
I think it's well said.
Yeah.
So something we talk a lot about in our business and in our circles is AI and what's going to happen to a lot of different professions, right?
Yeah.
And I think it's relevant for this audience because the folks that you help at Mobilization Funding, they're probably on the better side of the AI equation more so than anybody else.
I think so.
Yeah, I mean, as we talk about our world and accounting and attorneys, I mean, man, we're in for a wild ride over the next couple decades. So what would be, two questions, okay? As you're speaking to the audience of, your customer base, what would you tell them about AI and what may come there? And as you're talking to your daughter or my kids, what would you encourage them to do over the next 20 years to set themselves up for a successful career?
Yeah. I think number one is as it relates to commercial subcontracting, I think a lot of the AI tools, first off, I don't think it's even made it to the commercial subcon. It hasn't even, the surface hasn't even, actually I had one of our customers email me today saying, hey, I'd like to talk to you about AI. I have some ideas on how we're leveraging AI. I'd love to ask you a few questions on how the financial services industry is using AI and then try to marry it up. Are there any cross functionalities there?
Interesting.
But as far as commercial subcontracting, I think it's going to be a lot around billing.
Okay.
A lot around scheduling.
Yep.
I think it's going to be a lot around finding new opportunities for growth, like finding new jobs.
Okay.
Right. But functionally,
all those things sound helpful.
Yeah,
to that
it's super
market.
helpful.
I mean, all those seem better, like just efficiencies.
Yeah, super helpful, right?
Right.
But to replace workers,
no,
it's just not going to. I mean, you cannot replace someone doing hard labor in the specialty trades.
Yep.
I mean, might be figured out one day. Ain't going to be in my lifetime.
Maybe it actually helps the talent curve there because I know there's been labor shortages in many markets throughout the U.S.
There's absolutely labor
Maybe
shortages.
As we see more of this next generation realizing that that's a really good path for them, we might see more labor.
Well, think about college graduates.
Yep.
They're told they need to go be an investment banker.
Yep.
They need to go be a commercial banker or a consultant. The trades is an incredible option.
Yeah.
But I think the trades, actually a friend of our company's brought this conversation up the other day, is like, how can we get more people in the trade, more leaders in the trades? And I think the only thing that needs to happen is, what does a path forward look like in the trades?
Right.
What does a growth, a career look like in the trades? Being completely transparent and open about that. And then when you have new entrants, new folks that come in the trades to be the leaders, and then they're going to create their own paths.
100%.
It's just getting people in the boat, right?
I think it's a huge entrepreneurial sector.
Huge.
I love the apprenticeship that takes place in the trades. It's one of the only industries that truly has that defined still.
Yeah.
I mean, some of the best companies I work with, they do ride-alongs for a year with their new technicians.
Yes.
I mean, in our world, we're not doing. I mean, we get thrown into the fire.
Imagine being a 23, 24-year-old recent college grad and having that opportunity to go work for a construction company, ride along and say, hey, you're going to get paid to learn.
Yep.
And you're going to do some labor. You're going to do a lot of labor too, but you can only learn by doing.
Right.
So yeah,
some of the best entrepreneurs that I've worked with in the trades started at a really large contractor, and then they went out on their own.
Yeah.
And the one takeaway I had from that is, if I were to spend my entire career working at, I don't know, some financial services institution, I don't know that I would have ever learned how to run that financial services institution. No. You know what I mean? Because I would have been in sales, and it's more siloed.
It is.
I think in the trades, you really are learning how to run that business.
I agree.
You're dealing with customers, you're dealing with operations, you're dealing with service, you're dealing with internal. You really are learning how to run a business by getting into the trade space if you have the mentality that you want to go do it.
Yes.
Everything is what you make it. But I think there's a lot of opportunity for people to go out there and say, I worked for $1 billion, plumbing contractor for the first 10 years of my life. And then when I was 30, or my career, and then when I was 32, I started my own. And then 10 years later, I own a $20 million company. That's powerful, man.
I mean, if you can, we have a customer who spent, I'd say 15 or 20 years of his career in accounting and financial advisory. And he said, you know what? I'm done with this. I'm going to go start my own commercial painting and drywall business. Dude understands customer service, understands finance, understands how to deliver a really solid product, understands scheduling, and understands strategy. The dude's a weapon. Like, I mean, an absolute weapon.
And has the respect of the industry.
And has respect, right? And that is someone who has the and there's a lot of other people out there, by the way, that can do that. You just got to find the right opportunity.
So what do we tell our kids to do then, going back to that question?
Man.
That's a tough one, I know.
I mean, for like, I'm thinking about my daughter, right? I mean, the first thing with AI, social media, and all that type stuff, I'd like to think to myself, you know, this sounds so silly. Follow your heart and use your mind. Right? Don't rely so much on technology that you stop having your own voice and stop having your own sort of ability to decision.
Objective thinking.
By the way, back to the leadership question you asked. Decisioning. Too many leaders sit on something and never make a decision. That is the worst decision you could possibly make. Make a decision and live with it. And that's one incredibly detrimental way you can lose the respect of your people is by having the inability to make a decision.
I like that.
I think that's another one.
I like that. My answer would have been humor.
I want to know your answer.
Well, mine would be humor.
Okay. All right. Yeah.
Because I remember we said underrated, right?
Underrated.
So not super obvious. I think you know, people talk about like building personal relationships and all that, and like I lead with humor for that, right?
That's so
I mean,
good.
you know that about
me. And that
me.
engenders trust.
And it's genuine too, because it's like we're allowed to have fun, by the way. Like nobody said that we had to go work for 40 or 60 hours a week and not enjoy it. You're allowed to like people. You're allowed to like your coworkers. You're allowed to like your customers. You're allowed to have a laugh. And I think everyone's so serious all the time nowadays.
I mean,
it's just nice to have a little bit of brevity to start a call, a little joke here and there, you know, kind of de-escalate the situation, if you will. Not enough people are focused on getting a smile.
You're so right, guys. You don't have to take yourself so seriously to be a leader.
And like, to be respected.
And to be respected. Actually, there's an element of a little bit of self-deprecation that actually makes people like you a lot more. Right? Because you don't take yourself so seriously. You can laugh at yourself a little bit.
You can laugh at yourself a little bit. I mean, everyone just seems a little uptight nowadays. And I think if we were transported back to like the 70s or 80s, I don't know if it was like that then.
I don't know.
Who knows?
All right, guys. Graham, dude, thank you so much. This has been awesome.
Thank you for having me.
Yeah, this has been amazing. Folks, I hope this has been incredibly informative to you. I know Graham's available. I'm available. Reach out to us. DM us on LinkedIn, through the podcast, through YouTube. We'll answer any questions you have. But this is the Mobilization Mindset. Thank you for joining us, and thank you, Graham.
Thanks, bye.